All right, chapter number 9, which is accounting for receivables. Again, this is an overview of our objectives. There are basically two objectives in this particular chapter. The first objective is credit card sales, understanding that there are three types of credit cards that the consumer may present to you in the buying of goods. And we account for those three credit cards differently. The second objective then is going to be if you, the company, are financing the sale, that is, if they used your credit card, they may not pay you. And if they don't pay you, that's going to become a bad debt. So two objectives. First are the different types of credit cards somebody could present to you. And the second is if they present to you a company card, you then are going to have to bear the potential risk of loss. Well, let's look at the first objective, and that is the type of credit card they present you. There are three types of credit cards, and these are my categories, not the textbooks, not industry. They're mine to explain to you the type of journal entries. One is a bank card. This would be a Visa card or a MasterCard. And when that card is presented to the merchant will be paid that day from Visa or MasterCard. They will actually have an electronic transfer the day of the transaction into their account. Therefore, the journal entry to account for a bank card when it's presented to you will be to debit cash and to credit the sales. But Visa and MasterCard don't allow you to use their card free. They will charge you, the merchant, a fee. And so if you have $1,000 of sales, you would debit cash for the amount of cash you're going to end up receiving, the $1,000 less the fee. You will debit the fee and you will credit sales for $1,000. So number one, a bank card. Number two is a non-bank card. And there are companies that allow consumers to use credit cards that are not sanctioned as banks, and as such, you, the merchant, when you sell to a customer on one of these cards, you don't get cash that day. Examples: Discover Card, American Express, Diners. Well, the only difference then between a bank card and a non-bank card is that the merchant will, instead of debiting cash, will have to debit accounts receivable. They will also have a debit to credit card fee because these companies, like bank cards, do not let you use their cards free of charge. And then you will credit sales for, in our example, we've used $1,000. So the first is a bank card. You get cash that day. The second is a non-bank card. You get the cash some time from now, but you have to book the sale. And the third is the company card. The company themselves have their own credit card. You will debit accounts receivable, and you will credit cash. What then is the difference between the first two and the last one? Well, in the first two, for a fee, you are offloading the risk of non-payment. Because the credit card company, be it bank or non-bank, is guaranteeing you that you will get your cash less a fee, and you don't have to worry about bad debts. The company cards, you have to worry about bad debts. That brings up our second objective in this particular chapter. This objective, bad debts, I hit extremely hard on the exam. Students have a lot of trouble with this, so I want to make sure you guys get this down. There are two basic ways to account for bad debts. One is a GAAP method, that is generally accepted accounting principles, and one is a non-GAAP. The non-GAAP method is something called the direct write-off method. The reason it is not GAAP is because it does not match revenues and expenses. The GAAP method is something called the allowance method, or I use the term the estimated method. What it will do is, in the time frame of which the goods have been sold, or in the time frame of which you still have the receivable on your books, the customer has yet to pay you, you estimate what the bad debts will be. And I think it is this area that the students have the most trouble. because under the allowance method, there are two basic ways. A percentage of sales, which is called an income statement approach, and a percentage of accounts receivable, which is called a balance sheet approach. So we need to know that you have the direct write-off method, which is not GAAP. You have the allowance method, and within the allowance method you have two sub-methods, the percentage of sales and the percentage of receivables. One of those methods takes into account a new account that we're going to have, the allowance for uncollectible accounts. Both of them have the uncollectible accounts. That is, when I say both, I mean the percentage of sales and the percentage of receivables. But one takes it into account in coming up with bad debts, the other does not. And that is going to be our focus. We have a lot of questions we are going to work, and hopefully that's where you have to key in as to what the differences happens to be. And that is chapter number 9.